Hello everyone, and welcome to this session in which we would look one of the 5 key activities in auditing the inventory and warehousing cycle. In the prior session, we looked at the 5 key activities, and we mentioned that number 1 activity, which is the purchasing and the recording of raw material, labor, and overhead, is already covered in the acquisition and payment cycle. Then we covered internally transferred asset and cost. This was a separate recording, which is the cost accounting record. Then after we ship the goods and we record the revenue, this is covered in the sales cycle. In this session, we will focus on physically observe inventory. Well, this is a must. And if you remember in the prior session, I mentioned with you that auditors are required to observe the inventory count. And this came about after 1938 McKinsey and Robinson case, where this company created or counted $20 million of pharmaceutical inventory that did not exist. It was a thin air inventory. After this case, the AICPA requires auditors to do what? To physically observe the count of the inventory. And this is what we will discuss in this session. How do auditors go about observing inventory? Let's go ahead and dive deeper into this topic. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Let's go back and review real quick. Once again, this is a requirement after the 1938 McKinsey and Robbins company. If you're interested, read about it. The fraud involved recording non-existing inventory, and the auditor did not physically verify the inventory because it was not a requirement. And this incident reveals a critical gap in auditing practices, which led to the current standards. Which are what? What's the current standards? Auditors are now required to observe the physical count of inventory, And notice, observe. It means look over, like kind of supervise this process. They must evaluate the way the client, the auditee, is doing the count and test the reliability of inventory information. Can the auditor jump in and do some counts on a sampling basis? Absolutely yes, and we will discuss how they do it in this session. So to meet this requirement, what should the auditor do? First, they have to be present during the inventory count, either at year end, if it's an annual account, or during cyclical counts conducted throughout the year. They have to observe the actual counting process, which we will discuss in this session. And during this process, they will talk to management, they will talk to employees to learn about the process regarding the counting procedures. And they should perform independent test count to verify accuracy. Now I'm going to go over this process, which is observing the actual count, and just show you how they do it, what they do, so on and so forth. Starting with what should they do first? Well, before they do any single count, before the auditor tests any count, what should they do? Before they even start this process, they have to understand the client's business. Why is this important? Because different companies will have different types of inventory. You could be auditing a company that produces chocolate bars, chewing gums. You could be auditing a company that produces computer chips, a company that's in construction, a real estate retailer, so on and so forth. So you have to be familiar with the client practices, the client industry. And this includes being familiar with their inventory valuation method and potential obsolescence. You have to know, for example, if it's a software company, could they have old software? If it's a retailer, let's keep it simple. If it's a retailer and they're selling electronics, you have to be familiar that certain electronics, they could go obsolete and they become obsolescence due to technology changes. Are you familiar with this type of product? So the first step is storing the client facilities, and this includes, you would look at their receiving area, storage, production, planning, and record keeping areas. So you could be looking at different places where they receive the product, where they ship it from, maybe inside the warehouse, how they keep inventory separate for production purposes. You want to take a look at their production facilities. And why tour the facilities? It helps you understand the inventory flow. How do their inventory goes, for example, from raw material to production, from production to ending inventory, so on and so forth. You can physically see it. Now, obviously, it's better if you have a supervisor or someone who knows about inventory accompanying you. And this allows for asking questions, inquiries to gain more insights. And what kind of questions you would ask? What kind of question? What is this location for? You'd ask them, what is this location for? Say, this location is to store items that already ordered, ready to be shipped. Can you show me the receive and dock? Can you show me where you ship the product from, or where you receive when you have incoming raw material? Where do you receive it? Where do you ship your sales from? Where do you segregate the inventory that's already sold? So if it's sold, where do you put that inventory? Separately? Show me where you put it separately. Why? Because when I'm counting, I need to know that this inventory is already sold. It should not be counted. Then you want to assess the business risk. What do I mean assessing the business risk? It means evaluate the inherent and business risk that could lead to material misstatement in inventory. It's basically not all businesses are the same. Again, you could be auditing a company that produces chewing gums, or you could be auditing a retail that sells gold and jewelry. Two different items. So several operational and environmental factors can increase the risk. And each of these factors would require careful assessment and alert response. For example, if the company has a short product cycle, what does that mean? It means they produce something, it goes up real quick, and it goes down. Because the sales cycle could go like this, which is a long one. It means they start, they grow, it takes time, then it starts to slow down slowly. And in certain businesses, what happens is it goes up, it goes down. What's that going to do? It's going to make some of the product obsolete. There's a higher risk because the product goes bad fairly quickly. And what are we talking about here? What could be short product cycle? Usually technology. For example, a smartphone manufacturer may hold excess units of previous model that quickly loses value once a new version is released, and that's not good. They have a short product cycle that's going to increase the risk of obsolescence. Well, this is it. Potential obsolescence of inventory. Inventory that could be outdated or no longer usable poses a valuation risk. Example, a pharmaceutical distributor may face a write-down if medication near expiration are replaced by newer formula. Well, you have to be aware of that. Or if the FDA says pull it out of the market, you have to be familiar with those rules that inventory, whatever they have, now it's obsolescence. Other items, if they're using just-in-time inventory system, which means it's going to minimize holding costs, but it's going to increase exposure to supply chain disruption, leading to incomplete or misstated balances because you don't have the items to complete the product or to sell the product. An auto parts supplier using just-in-time may have no buffer stock if deliveries are delayed or affected by some natural disaster in Japan or like COVID or anything like that. It will affect year-end ending inventory level. Again, it's increasing the business risk. Also, you could be something related to this is reliance on key suppliers or one or two. Well, when you are dependent on few vendors and for one reason or another, there's, let's assume it's an overseas, there's a war, civil unrest, strike, natural disaster, well, inventory is not available and this is going to create a problem for you. For example, a closing retailer relying on a single overseas factory may face shortage or delivery delays due to political unrest, or shipping issues. Let's assume they are functioning in a third world country. There's a political unrest. The port is closed or the airport is closed. They cannot ship you the product. Sophisticated inventory management technology, complex system introduce the risk of programming errors, integration failure, or unauthorized changes that might affect inventory accuracy. So what type of system are you dealing with? So an example of a company using fully RFID based tracking system may misstate inventory if the system fails to update real-time movement properly. And what's RFID? Radio Frequency Identification. It means you tag your product, and you can scan the whole shipment, and as it moves you can scan it, and it will update the record that it's being moved around. What if there's an error? So those are different things that could influence assessing business risk. You also want to look at materiality and inherent risk. Now here we talked about really those are business risks. We're going to talk briefly about inherent risk. Performance materiality is usually high for inventory, especially if the inventory represent the largest account balance or the largest asset balance or the largest current asset. If it's not the largest asset, sometimes could be, if it's a retailer, you could have PP&E, but oftentimes these days there's less PP&E, property, plant, and equipment, even for retailers, and larger inventory amount. Therefore, usually performance materiality is usually high. Inherent risk, here we're looking at small and expensive item. If you're auditing small and expensive item, they're easy to steal, easy to get lost, like small diamond, that's a problem. If you have items in multiple storage location, it's harder for the auditor to track the inventory. If the company is using a complex costing system that could be subject to errors, prone to errors, it becomes more inherently risky. Inherent risk is set higher. Also, you're dealing with items that's a potential obsolescence. They affect the value. You have to write them down. But notice, inherent risk, business risk, and inherent risk, they're kind of related, but I want to make sure you understand that business risk is the business overall. Inherent risk is specifically inherent to this product cycle. Business risk is something that's affecting the whole business. Auditing standard, again, what do auditing standard require? We'll talk about this. Auditor must be satisfied with the client inventory counting method. They also need to rely on the client representation about quality and condition, but obviously they can also do their own testing. So the auditor responsibility here is to meet those requirements. They must be present when the client counts the inventory, observe the client's counting procedures, and talk to the client about counting procedures, and if needed, perform independent test count. And if you remember, we saw this on slide 1. I just wanted to show it to you again to remind you, because it's very important to differentiate, which is I'm going to show you this on the next slide. What do auditors do versus the company? Clarifying roles. This is important. Who's responsible for what? It's essential to distinguish between observation and responsibility for the inventory. The client is responsible for setting procedures, making and recording counts. The auditor is responsible for evaluating those procedures, observing, and yes, we do perform test count, and our job is to draw a conclusion whether that account is fairly stated. Now, sometimes what happens is this. The company might have inventory in public warehouses because they don't have enough space. What they do, they rent public warehouses. What if the inventory is stored in those public warehouses? What do you have to do? Well, generally, you would send a confirmation to the warehouse. If you are satisfied with this, that will be that. Now, if the inventory is significant or you are not comfortable with that confirmation that's coming from the warehouse because maybe you don't believe they have a proper internal control. But sometimes that warehouse could be audited and the auditor, they could send you their report about their internal control. You could be comfortable with that. But if you are not, and if the inventory is significant, I would say you might want to go up there and audit them. How would you do it? You could review the custodian's inventory procedure. Again, you could obtain an independent auditor's report on the custodian's control procedures to make sure that they are accounting for everything properly, or you could observe the physical count held by the custodian if practical. Sometimes the warehouse could be overseas, who knows. But those are the options, so keep in mind that could be the case. Let's take a look at this multiple choice question from farhatlectures.com. When an auditor is concerned about overstatement of the inventory account, the best audit procedures to detect damaged inventory would be to do what? So our concern is overstatement, and that is the norm for inventory. Inventory is an asset. Always the risk of an asset is overstated. And remember, when you overstate ending inventory, you understate cost of goods sold, which in turn you overstate net income, which in turn you overstate equity. Let's look at option A. Conduct a tour of the client inventory facilities. Is this a good practice? Yes, it's a good practice. But for what purpose? To get familiar with the inventory flow. that doesn't answer the questions whether you can detect damaged inventory. So conducting a tour is a good thing, a good starting point in the inventory auditing cycle, but it doesn't help in detecting damaged inventory. Take a physical inventory count to record damaged item. Well, hold on a second. This is very tempting, but you have to be careful here. Do the auditor takes a physical inventory count? Do we count to record damaged item? No, we don't. We do the observation. But let's hold on B. Compare, let's go back. Compare inventory turnover from previous year's inventory to the current year inventory. Well, yeah, it's going to give you good information whether certain items are moving or not, how fast they are moving or not, and they could be not moving because they're obsolete. It could be, but inventory turnover don't tell you specifically about damaged inventory. It tells you something is not selling or they have more inventory than before. It could be just they have more inventory. None of it is damaged, just they bought more inventory. So the turnover is helpful, but not to specifically answer this question. D, by process of elimination, D, I think, is the answer. Observe the condition of the inventory during the client physical count. And this is exactly what we do. We observe the condition of the inventory during the client physical count. And if needed, then next what we do is we test. We ask questions. We say, okay, let's take a look at this item. We suspect that this item is no longer as valuable as when you bought it. Let's assume we're looking at CD-ROMs for Windows 95, right? This is an extreme example. It's still in good condition, but we know no one's buying Windows 95 anymore. So this is obsolescence. So you observe the condition of the inventory during the audit client physical count. Then, if needed, you will do the count. So that's the first thing you do. But you don't take a physical inventory count to record damaged item. The client might do that. The client should do that. I remember at one Christmas when I was in college, I work at Walmart. I work a third shift. And my job was to go around and look at all damaged item and create a ticket that this item is damaged. But I was a Walmart employee. I did this. I took account. The auditors don't do that. That's the job of the company. So the best answer for this is D. Auditing is very tricky. The question, especially on the CPA exam. So you have to know what are they asking you. Because if you really think about it, all four options are correct, but for different reasons. That's the tricky part in audit. They give you four options. They're all correct on their own if you read them on their own. Yes, we conduct a tour of the client inventory facilities, but it doesn't answer the question here. Yes, we compare inventory turnover from the prior year. Yes, someone takes physical inventory count to record damaged items, but it doesn't answer the question that's being asked. What should you do now? You want to go to Farhat Lectures, look at additional resources, MCQs, resources, lectures, true, false, if available. Anything that's going to help you, whether you are an accounting student or a CPA exam candidate or studying for any professional certification. The best investment you can make is invest in yourself. Good luck and stay safe.